Hey, this is Charles Dobbins. Welcome to this week's vlog. And this one is a really fun video vlog from me because I'm going to talk about a former student of mine who's out there doing it. He works in the south side of Chicago, and he sent me over a video of his newest deal. Okay, now, listen, all I want you as a new potential multifamily investor, as somebody looking to get into the multifamily business, what I want you to do is see how he did his presentation. I think it's one of the best presentations I've ever seen. I loved it. I hope he nails it. And I can't imagine he won't when you see how he's put this whole thing together. So I am going to give you the video. I'm going to run the video. This is the only introduction, and we're going to, you can take a look at it. Contact him. His name is Steve Rich. Great guy, lives on the south side of Chicago. He and his lovely wife, they do a great job. I think he owns currently about 60 units on the south side of Chicago. This guy's going to be a multi-millionaire from multifamily, and he's doing it the right way. So check out this video and reach out to Steve. He's a great guy, and I'm sure I'd love to hear from you. So enjoy this week's vlog.
Hello, and thank you for joining us, taking some time out of your schedule to hear about our most recent and extremely exciting investment opportunity. It is a 60-unit building on Chicago's south side, located on the lakeshore and also inside an opportunity zone. I'm Justin Connor, owner of Connor Capital Management and Consulting, and I'm joined today by Stephen Rich, our head of operations and also owner of Rich Ventures. Steve, thanks for joining us.
Thank you, Justin.
I thought it would make a little bit of sense for us to go into a little detail about the area as a whole before we dive into some of the numbers as well as our plan for this specific asset. There's been a lot of development in the south side, but specifically in this area. I think a lot of people are aware of the Obama Presidential Library going in Woodlawn, but there are a few other things that you'd like to mention as far as developments in the area.
The South Shore, South Side area is heating up. It's a place where a lot of investors are turning to seek returns that they can't get in their own backyards or that they've lost from yesteryear. Another very exciting thing is that the Tiger Woods golf course is slated to be in the South Shore area, along with the fact that we do have the proximity to the lake that you talked about. And this deal in general does a lot to fit right in the criteria of what we specialize in, which would be that 30 to 35,000 per unit price range, value add opportunities.
Absolutely. With that in mind, I feel like we can go into a little more of the specifics about the building itself and some of our plans for how we're going to go about this renovation.
Okay.
And right now, my understanding is about 25% occupancy that we'll be dealing with. So there's going to be some significant reno, but also we'll need to be repositioning the asset as a whole. And that provides some unique opportunities for us as well.
Absolutely, Justin. I think that's a great point. For the renovation, I'd like to touch on the fact that the 25% really excites me because we have the opportunity to come in and without spending money for evictions or legal, we can just start the actual renovations on those 30 to 35 units that are vacant.
Realistically, we're talking about, when you say light reno, you mean paint,
very right,
finishing floors, things of that nature.
Very minimal.
Exactly. And a lot of the major rehab costs are going to be larger things like dealing with roof and some deferred maintenance for the building itself, but not as much a full gut of individual units.
There's going to be a lot of cosmetic renovations
Certainly.
on this place, stuff that's going to show the tenants and the area that the owner cares about the place. We have landscaping and things to beautify the property.
New laundry room, certainly.
Exactly.
Things of that nature that make it an amenity for the tenants, as well as another revenue stream for us and our investors, by providing a fully functional, clean, safe place to live, right? Like we talk about all the time. And you said the timeline. We're looking at 1 year to move it to about the 90% occupancy range that we want to shoot for.
Right, because we have vacant units. We can go in and just do the renovations, turn them over, and then occupy them. So it'll be on a sliding scale. We will slowly creep up to that 90% occupancy over the year.
Excellent. One note I certainly want to make is that our property manager, Alan Redzik of Real Realty, currently manages about 100 units in our portfolio. In addition, manages 1,500 units as a whole. So it's a strong system to be stepping into, but specifically on this deal, he's managed this individual asset for multiple years for a previous owner. So it gives a very unique insight into the exact expenses that we'll be dealing with and the exact ins and outs of how to manage and rent this individual asset. I think it serves us well, and I think that is something I'd want to jump into, in that when we were underwriting this, I was able to use the actuals from Alan and compare them to what the seller's disclosing. And then in the model, I prefer to use the actuals, right? So knowing the current expenses aren't running at that level, but they will be. I think it gives us a stronger position to negotiate, and we were able to negotiate significant credits based on our request for repairs and the understanding that we have that knowledge and know the expenses are going to be higher than they're projecting or showing us. I think that was beneficial for us to be able to put this under contract for $33 a unit.
Yeah, I think that's something that allowed us, like you said, to get the best value possible from the seller to pass that on to our investors.
Certainly. And with that in mind, I think what everyone kind of tunes in for to really get to it, certainly you want to hear about the deal structure, but what's in it for them, right? So let's get into what the returns are going to look like. Our expectation for this deal is an annualized return for our investors of 18.6%. And that's going to be based on both profit sharing and a preferred return. The annual preferred return would be paid first. So after all expenses from the building, the investors receive an 8% preferred return on the capital that they've contributed. And then the profit share is split 35% for the deal sponsors, management, and 65% will go to the investors themselves. So the combination of that preferred return and the profit sharing is how we get that overall yield, that annualized yield of 18.6% for our investors.
It's a great return. And I think it's worth noting that the conservative underwriting, this is off of a 720 monthly average on each rent. Okay. And there's a huge uptick that correlates to the investor return by just moving that $10 to $730 or $740. So that's something that, we like to underpromise but overdeliver.
That is something we work towards. And I think a couple other things just going on overall deal structure. You can have a normal expectation that for this and any syndication, you're going to have a private placement memorandum. You will have a subscription agreement and then the operating agreement as well. So just for any investor looking to get involved, you can expect that those 3 legal documents will be necessary to participate in any investment with us.
Absolutely. To cover us and the investor.
Certainly. So that should mainly cover the initial way to work with us and investing capital in a deal and earning that 18.6% return. But when we're putting these deals together, there is an opportunity to help us with the overall structuring. And certainly we'd want to offer that to an investor who might be interested in boosting their return beyond the 18.6. So that would come down to helping us secure the financing and also possibly helping us raise the capital that would earn more ownership of the deal, which of course would be reflected in a higher and larger percentage of return for the capital committed. We call that our grantor program. And in addition, if someone was not looking for a very long-term investment, was more interested in working on a shorter-term basis by providing capital to help us vet and secure deals, but still have the opportunity to earn a significant annualized return by deploying that capital multiple times, that's another reason to get in touch, and it's called our Earnest Money Program. And if you're interested in either one of those or just have questions about the deal as a whole, please reach out to us through our email or by phone. Steve, is there anything else you want to go over before we wrap up?
Just that there's a limited amount of capital needed for this investment on a first-come, first-served basis. We do have a $2 million purchase price with $525,000 for the renovation budget. So because we're financing the renovation and the purchase together, we'll just need a little bit over $625,000 to complete this deal. So if this seems like a good fit for you, we'd love to work with you. Please give us a call or send an email, and we'll get in touch with you soon.
Fantastic. All right. Thank you for joining us.